Investors Chronicle.
Welcome back to the Companies and Markets Show. On the docket today, the changing face of ESG in light of warfare in Ukraine, Russian stock volatility on various platforms, and why is the FTSE weighted so heavily towards value shares? All that before sitting down and talking to Deputy Editor Dan Jones about his long read this week, Running the Rule Over the Subscription Economy. Welcome back to the Companies and Markets Show. It's Thursday, the 10th of March, the year of our Lord 2022. Joining us on the podcast, Alex Newman. Hello.
Hi, John. How you doing?
Good, thank you. Julian Hofmann.
Hello, John. Good afternoon.
Hi, Julian. And a voice that will be familiar to IC podcast listeners, host of the IC interviews, Mary McDougall.
Hello, shoved on the other side.
I know. There was no IC interview this week, but we couldn't have 1 week of you off the air. Mary, we're going to get started with something that you actually wrote last week and that we touched on a little bit in last week's Companies and Markets Show, and that's in the continued fallout of the conflict in Ukraine. One of the implications is for ESG and ESG funds, and your piece was
The changing face of ESG.
The changing face of ESG. So, yeah, I guess what are the main implications for the conflict on ESG?
Well, I think this is a huge topic and it's sort of going to take a long time to unravel. I think there are three key areas to this. So the first is, do you want to be doing business with an autocratic state? ESG managers were scrambling to remove Russian stocks before the stock exchange was suspended. JP Morgan was removing Russian bonds from its ESG government bond indices, and so you might ask why they were there in the first place. So that's the first question, like where you actually want to invest. It's complicated. I mean, you could argue for the ethics or the morals of investing in most places. The second area, which is going to be heavily impacted, is defence. So funds, ESG branded funds, have typically excluded defence companies. Now defence might be seen as a social good. You've seen some that one of the largest banks in Sweden has done a U-turn from not supplying any money to defence companies, and now it is. You'd also seen before, defence companies find it quite hard to raise capital because people wouldn't support them. So there was an instance, Serco dropped out of the bidding for government contract managing nuclear weapons before because ESG-minded investors wouldn't support it. So there's a shift in attitudes towards defence companies, which we're already seeing. I know you talked about that last week. And the third area, which is a huge one, is energy and energy security. So ESG-focused funds, lots of them have exclusionary policies on fossil fuel. You know, people who have said that the use of gas and nuclear as well, which are less heavy pollutants. Well, nuclear isn't, but that they've been undermined. They undermine the green vision. Might pause for thought. Europe's been left quite heavily exposed. You've got Italy considering reopening coal plants. I think Boris Johnson said this week that the UK might start upping its production of gas. It'll be interesting to see how ESG fund managers tackle this. On the other side, energy security is going to be important. Maybe more. There'll be more investment into renewable energy, so that might benefit too. But I think another important thing to say on ESG generally is it's very poorly understood and difficult to interpret, and it's actually about analysing those factors. So it's not to say that you can't invest in anything. So if you're investing with an ESG mindset, that's a little bit meaningless in a way, because it's about how you analyse these factors and which ones are excluded and which ones aren't. But as the industry is interpreting it currently, those sectors that we've discussed have generally been excluded. Sorry, that was a very, very long answer.
It's really interesting, isn't it? I mean, one of the points, I suppose, is it shows ESG branding, I suppose, is a little bit of a misnomer, isn't it? Because as you're saying, it's a style of talking about investing and approaching investing, and when you stick a label on it, you're sticking a label on basically the debate around ethics, which is always going to shift given the world we face, and you know how suddenly, for example, supplying weapons to a country looks like the right thing to do, as opposed to, you know, always likely to cause harm to others. So it's kind of a chimera, isn't it, ESG? Even though, but I sort of take from this is that it's not going to disappear just because it seems like a muddled concept now. It's almost reinforced the idea that ESG is an important lens, but it will keep shape shifting in a way.
Yeah, or maybe to an extent it was disappear is not the wrong word, but maybe it was going to become proliferate all areas of investment that it's not really talked about anyway, and maybe this would accelerate that.
Yeah. I mean, I mean, ESG investing is investing, isn't it? Really, it's everything. So. You know.
I mean, I've always thought there's always been an element of magical thinking around it, isn't there? I mean, there hasn't quite. It's never theoretically sort of found firm foundations. I mean, you kind of feel that it needs several years to settle down, doesn't it? And then you can make an accurate assessment of what it actually is on a theoretical basis. Maybe that's the problem. I don't know.
Mary, another article you wrote, and this time it's in this edition of the magazine, page 8, if you have your magazine in front of you, listener. It's about trade cancellations and forced sales add to Russian equities risk. And so this is all about market volatility causing liquidity issues on various platforms. So what's gone on there?
Yeah, this is quite interesting. There's sort of a few things to pick out. So first of all, the steel manufacturer Evraz and precious metals mining company Polymetal, which are two companies that have large parts of their businesses in Russia, but they do have primary listings in London. They were the first and second most bought shares on the platforms this week, because their share prices plummeted, and opportunistic investors think that maybe they can get a dividend for more than what the share price is. But actually, I think today the shares in Evraz were suspended because Roman Abramovich, when he got his sanctions, he's a 30% shareholder, I think, in the company. So that shows one risk of investing in these companies. There was a moment where the London Stock Exchange had to cancel the trades in Polymetal for about 20 minutes on the 8th of March because it was just well, the exchange said that it was been down to erroneous trades, but there's been a huge amount of volatility. And a really interesting one on the platform eToro, which is an Israeli platform. They ended up, so before, this was on the last week, or this was on the 25th of February, they automatically sold. So they had about 12 Russian stocks on the platform. And they automatically sold one of them when it got to 1 cent. So the share price plummeted, and because of the systems and controls they had, I don't know, maybe accidentally sold them. And so this,
I was going to say, was that an error in there? Not an error, but like an issue with their automation, or? Well,
they sent me quite vague wordings as to how it happens, but they do reserve the right to be able to do that. And they said it. They called it I can't remember. It was an operational issue, but yeah, they've reimbursed all the customers at the price that they paid them for, because they sold them as they were at the very lowest they could possibly be. So there are these interesting liquidity nuances coming up.
Actually, it's interesting to move on from that, Mary, because it ties in exactly with the various kind of mea culpas that have been coming out from the asset managers this week. So we had several having to come out and say that they're losing quite a lot of money in Russian investments. So the biggest one was probably Aberdeen was saying they're going to lose 2 or 3 billion of their clients' money in Russia. You had Legal and General Investment Management. Initially, they said it was 0.1% of their total assets, but so Bloomberg did some digging. It turns out they're one of the second highest holders of Russian-denominated dollar bonds. So nobody knows where that's going to end up. And there are banks as well who are coming up with some really scary big numbers, like Banco Unicredit, which is in Italy. They're saying that they could lose 7 billion just on their Russian operations, if assuming that they now have no value at all. Which I think everyone is now saying, well, they're never going to get anything out of that situation as long as the sanctions and the conflict continue, or the Russian state just seizes it in the end. I mean, that could be the ultimate loss. So it's all dovetailing quite alarmingly, really, from that point of view.
Yeah, it's like a horrible nightmare that won't end.
Indeed. But I mean, it's interesting because the same thing happened. I looked back at the history of this. The same thing happened in 1922. So loads of investors in the UK lost money in Russian railway shares after the Bolsheviks decided they weren't going to pay the debts from the Tsarist era. So it's kind of like history is repeating itself again in a strange sort of tragic and comic way at the same time.
Yeah, happy 100-year anniversary.
Exactly. Yes. I did wonder if you still. I knew someone who had these. I think it was actually John Hewman had some Russian railway bond sort of certificates from way back that he sort of collected from somewhere. But it'd be interesting to see if you could redeem them now.
I think we know the answer to that.
Yeah, we'll have to look to the Investors Chronicle archives. I'm sure it was a lot of railroad bond buying 100 years ago when we were going to weekly press then as well.
Yeah, just as we went to war with Russia again.
Yeah.
Yeah, it's good to know time is a flat circle after all.
Well, it's like Karl Marx said, isn't it? It's the history repeats itself first as tragedy and then as farce. But anyway.
All right, and just moving on to our final topic of the day. Julian, you pointed out to us all earlier in the week an article in the Financial Times looking at the weighting of value to growth stocks in the FTSE.
Yeah, this is this was a really interesting position that the Financial Times has taken. But apparently, the valuation gap of the FTSE 100 is now at a 30-year high. So if you compare sort of global equities, the average value of global equities with the average value of the FTSE, it's now grown. The gap has grown hugely since 2016, and what the FT reckons that this is partly a byproduct of Brexit, so that there's a certain amount of discounting that's going on because of that, and that's finally feeding through into the valuations. But also there's this thing about the indices being dominated by a very small group of sort of mature companies that really are kind of old school, really, and they generate lots of cash and they pay out lots of dividends, but they're not growth stocks. And the Financial Times, the Lex column was saying, well, this may not be a bad thing, having an index that's kind of stable and not particularly expensive. From a value investing point of view, is actually quite sensible. I don't know what other people's view on this. I mean, you picked up on this, Alex, I think, didn't you, in the meeting? And what was your take on it?
Yeah, well, I mean, just to jump back to it, when I think the valuation discount you were referring to, I think they ranked that on a forward price to earnings. So the FTSE 100, for example, is on a sort of P of 12 at the moment compared to an ex-UK FTSE World index of 18. So obviously the world index is going to have a higher weighting to pretty racy, expensive US tech stocks, given they are some of the largest companies in the world. But yeah, I mean, we've talked about it. We talk about this a lot, given our kind of UK, if not bias, then focus on the mag. And we did a webinar a couple of months ago on value in UK multinationals. Where this topic was starting to loom into focus because of rising concerns about inflation and what that was going to likely do to the discount rate on premium 30, 44 times earnings growth stocks. But I mean, I think it's really interesting in light of the last couple of weeks because one of the criticisms that you alluded to of the FTSE 100 is it's still dominated by this kind of old world heavy industry, mining, oil and gas kind of sectors of yesterday, and that it's not a great place for sort of long-term wealth accumulation and growth. But actually, when events swing into sort of hard realities and commodities just blow through the roof as they have been doing in the last couple of weeks, it's actually not a terrible place for portfolios to be, and that's kind of reflected in the FTSE 100 being down. Well, it's still down this year by 2%, but it's nowhere near the 10% plus falls in the S&P 500 and Nasdaq even more. So yeah, yep. it's I don't want to sort of say it's the FTSE 100 renaissance because there's a lot of consumer facing stocks in there as well who are going to have to handle slowing economies and higher inflation, and that's no easy task. But rising interest rates, that benefits the insurers and banks that you're always looking at, Julian. Higher oil prices, great for BP and Shell. The Australian miners are just drowning in cash. It's kind of a better place to be, it looks like, at the moment in amid such uncertainty than in Silicon Valley. Mary, I don't know if you had thoughts on this as well.
Well, I was chatting to the CIO of Canaccord this morning, and I was just asking about asset allocation. I was quite surprised to hear him say that they are upping exposure to the US because in times of great uncertainty, the US has been the sort of dominant economy that's done better. And he was, yes, there are some stocks that have had huge sell-offs, but his view that was the companies like Amazon are not actually that highly valued.
Interesting.
Which was interesting.
One thing I saw Amazon doing this week, the announcing a buyback seemed like maybe a slightly biased here, given that we recently wrote a sell idea or Arthur wrote a sell idea on Amazon, but it seemed like a rather un-Amazon move that they're known for this relentless innovation and market share gobbling, but now they're financially gearing their way to a higher share price.
Well,
interesting.
It's a sign of financial maturity, isn't it? I mean, that's what it is. I mean, that must be an admission that somewhere in the hierarchy at Amazon, okay, well, we're going to struggle to achieve the same growth rates year on year, so we'll start doing what older companies do, which is buy back the shares and up the dividends, isn't it? I mean, the thing that nobody else ever talks about is what the effect of inflation is on those high valued shares, because when you look back, sort of in the 70s, I mean, I was born in the 70s, so I'm kind of obsessed with that decade. I'm sorry about that. What they had at the time was called the Nifty 50, which is the equivalent of the Nasdaq, the equivalent of the higher rated stocks that we see now, higher rated tech stocks, and it's like people like IBM, that kind of generation. And what happened in the early 70s, when inflation took off, that really affected the higher valuations of those stocks, and also their underlying earnings couldn't rise as quickly as say a miner or a oil company could in the same situation, because obviously that resource shock feeds through quickly to companies who are digging stuff out of the ground, whereas if you're trying to price something for a consumer, ultimately a tech stock is a consumer based product, that becomes incrementally more difficult when inflation takes off. So there is a link between a crash in those valuations and the rise of inflation, and I don't know whether people have taken that quite on board yet. But as we said before, history repeats itself in one way or another.
Yeah, I suppose the other benefit of buying US stocks now is you end up holding dollars as well, which in times of uncertainty is not a horrible thing given what could happen to currencies this year.
Oh, isn't? I
Yeah.
mean, have the gold sort of vending machines popped up again? I noticed that was a thing, wasn't it, a few years ago?
What?
It still is in Germany.
Oh, okay. I was going to
Yeah,
say,
like in the railway.
not in Devon then.
Not in Devon. No. I remember being in the railway station in Frankfurt, and there were sort of these vending machines where you could buy small gold bars. And I was kind of amazed that the vending machine was still there. In some way.
You sure that wasn't the chocolate bar, the gold bar?
Well, I don't know. I didn't have a spare £2,100 on me to buy one of those. It better be a pretty good chocolate bar if it was.
Okay, well, at the risk of being kicked out of our studio, we'll just move on to one final point, which is that this week in the magazine we have a special ISA supplement. And Mary, you've been involved in writing this quite a lot. So without giving too much away, would you like to share some of the lesser-known ISA facts that you think people should know?
Yes. So we're actually publishing a podcast next week on what to invest your ISA in. So I won't save that. I won't go over those details now. I think, yeah, ISAs are, as we all know, the staple of British savings. They've become more complex over the years. I think there are two things I'd like to highlight. One, lifetime ISAs. On the face of it, they seem like a no-brainer. You can pay in up to £4,000 a year. The government will top it up by 25%, which is really, really generous. But the caveats are that they were designed to help you buy your first house, so you can put it towards your first property so long as it's under a value of 450,000, or you can access it when you're 60. So, London house prices, the average house price in London is now 430,000. And house prices in the UK have gone up, and I looked this up for the podcast, but for the ISA thing, have gone up 24% since the lifetime ISA was introduced, and the amount, the £450,000 has been static. So if you want to access the money before, you have to pay a 25% penalty. Now, on the face of it, that sounds like you're just paying back the 25% that you got, but actually you're paying back some of your savings too. So if, for example, £1,000 is saved, it receives 25%, £250 on top of that. Then if you had £1,250 withdrawn, the 25% charge would then be £312.50. So that's a 6.25% loss. So you would have been better off not in it. So that's one thing to know about lifetime ISAs. The other thing that I've written about a lot, and it's a little bit of a pet project of mine, is flexible ISAs. So this is where you can take money out of your ISA and put it back in again with any tax year without that encroaching on your allowance. So it's not what stocks and shares ISAs were designed for, but it's quite a useful feature to have because you don't know, life happens and you might need money for it. And lots of people have written to me saying why they use it. Maybe it's to buy a car or to do up a house or for a bridging loan. But when the government introduced it in 2016, it wasn't made mandatory for platforms to offer it. So most of the banks do now, but the major platforms don't. Hargreaves Lansdown, AG Bell, Fidelity, and Interactive Investor don't offer it, but most of the other platforms do. So just something to think about.
Something to think about. Thank you very much, Mary. And yeah, as we say, there is a ton of ISA content on the IC website and in the magazine this week as well. Joining me on the podcast now, IC Deputy Editor Dan Jones. Tried to book Dan for last week before realising he actually wasn't around, was on holiday. Do you have a good break, Dan?
I did. It was lovely, thank you. It's good to be back at the coalface, as it were.
Yes, good to have you back, and good to talk through this long read that you've written, running the rule over the subscription economy. It's on page 24 of your magazine, if you've got that in front of you, listener, and obviously on our website as well. But Dan, just firstly, what inspired you to write, your 2,500 words on this in the first place?
Well, I think it's a really interesting topic. I mean, you think of subscriptions, you think of media typically, obviously things like the IC itself, traditional print publications, but in the modern world, you think of streaming, you think of music, perhaps things like that as well. And I think really over the last 2 years, people have noticed from a retail point of view just perhaps how many subscriptions they are now signing up to, they are a part of. During lockdown, obviously that kind of business really boomed, even though it was very much taking off beforehand. But what I wanted to explore was kind of the fact that these subscription models aren't just retail focused. They're starting to penetrate into all sectors, really all parts of the economy. A lot of businesses are really interested in shifting to that kind of model. Getting their customers to sign up to a service like that. Whatever sector they're in, be it manufacturing, be it education, be it all kinds of different parts of the company's landscape.
Yeah, I guess the key question, I guess, is what's the main appeal of a subscription model over business to business?
I think it's the ultimately it boils down to the recurring revenue streams that you can build up if you manage to get yourself a solid subscriber base. I mean, really, from that stems reliable cash flows, higher margins, better returns on capital. It really provides great things for a business which management I think are very keen on. They've looked at what was really the trailblazer of the last few years for this kind of model in many ways was a SaaS subscription, software as a service, rather. Companies, tech companies in the US, Adobe, I suppose, is the kind of the prime example in terms of a company that used to sell products to its customer base. Now it sells them on a subscription basis. You pay for your Adobe Acrobat or what have you on a yearly basis. You tend to value and need that for your business, so you're always going to be coming back. Investors really like this business model as well. You can tell that by the multiples they've been paying for SaaS. So I think management probably have an eye on that kind of valuation as well. But also investors like the reliable cash flows, reliable customer base, the ability to compound those earnings once you get a customer base and stick to it and build on it year on year. So that's the benefit for companies and for investors. For customers, the idea is, it provides flexibility. If you're a business buying this kind of subscription, you can spend the money out of your OPEX budget rather than CAPEX, which is quite attractive to a lot of finance departments. For a retail consumer, the idea, I think, is promoted very much as being about flexibility, again, lower upfront costs. And there's even a bit of, eco-friendly angle to it as well, in terms of ownership is not what it was, we are told, and renting effectively these things is the way forward from a environmental perspective.
You mentioned the impact of lockdowns and COVID, and was there a noticeable I guess boom in people signing up for subscription-based services in that period?
Yeah, absolutely. Certainly in the retail consumer space, you saw a massive increase. I think one of the things I touch on in the piece is Bernstein. They put out a note end of last year. According to their analysis, I think there's about a fifth of UK retailers developed a subscription service or product during lockdown. That was on top of 28% who already offered one. So that's a pretty big chunk of the market. Conversely, because I do spend a lot of the piece trying to explore some of the other sectors looking at these kind of models and some of the potential pitfalls, despite all the benefits I've just described. Conversely, there's perhaps the sense that lockdown, the pandemic, maybe put the brakes on a little bit some of the hoped for progress in other sectors, just because the financial implications of shifting to this model, if you have an existing product-based business, can be quite significant. You've got all this. Say if you're an equipment manufacturer, for example, you sell it on a case-by-case basis. Suddenly, you're going to start, doing something similar, not quite the same as leasing it out. that has big kind of balance sheet implications. You might need the financing to at the beginning as you start to shift to a point where revenues come in over time. And, the pandemic wasn't really seen as the ideal time to do that due to the financial uncertainty. So from a retail point of view, absolutely, it's really boomed. From a B2B point of view, maybe not quite so much, but it's still definitely a growing trend.
And in researching for this piece, were there any sectors that potentially surprised you that with how much they're looking into becoming subscription based? I mean, when I was reading it, I was surprised to read about the likes of Volkswagen, Volvo, and Motoring, who say they're really shifting onto a cloud-based softwares.
Car manufacturers are perhaps really an exception to kind of the sort of stuttering progress in the equipment in the manufacturing space that I just discussed, because a lot of them are really pinning their hopes on this kind of model for the future, or they say they are. We hear a lot, obviously, about the shift to EV, that being a massive future growth area for automakers, and you can see that in their public statements. But they've also been really bullish about, the benefits of software. One thing I touched on in the piece, the Volkswagen CEO was saying just the other month that they actually think software is going to be the big differentiator between cars in future, implying that the hardware, the car itself, is really going to be commoditized, and it's going to be the things on the dashboard that really start selling it to consumers. I mean, to me, that feels instinctively a bit of a reach. I think we're still a long way away if we ever get there from a situation where people aren't prizing their cars on performance and look and branding, but the manufacturers are really keen to almost commoditize the hardware side of things, and then really make a lot of money from the kind of maintenance, the kind of software updates they can provide to the in-car services, that kind of thing.
Great. Well, thanks a lot, Dan. I'm gonna leave the rest of your article for readers to seek out and read themselves. As I say, in this week's magazine and on our website. But thanks so much for that brief look at it now. And we'll catch up with you again shortly, I hope, Dan.
Great. Thank you for having me.
The Companies and Markets Show was edited and produced by me, John Rogers. And don't forget to get in touch with any questions or comments or feedback on the Companies and Markets Show. You can reach me at john.rogers@ft.com. That's john.rogers@ft.com. We'll see you next week.